people don't even understand chain of custody here, which is that you thought that you owned this Bitcoin. It turns out you actually may not actually own them at all. You thought that you were properly lending them out. You actually don't.
In a recent interview on the All In podcast, Chamath said that the regulatory agencies and lawmakers should treat the top crypto asset like security, even though it may not necessarily be one. Chamath based his argument on the volume and sheer size of the crypto market. According to the billionaire, another problem the crypto industry has is unrealistic yield expectations in decentralized finance, also known as DeFi protocols.
The crazy thing about this chart, when you look at it, and it's pretty obvious, is that we are collectively, in one way, shape, or form, basically trading up ever since 2018, really, with all the stimulus. Because if you look at the mean price of Bitcoin in 2018, it was a nothing burger. What we were talking about was sort of between a few $1,000s, $2,000, $3,000,
10,000,
and then 3,000. All of a sudden, when all of this stimulus money hit the market, look what happened to it. Yep. But I think something unique also happened, which is that people really understood how to run these very complicated off-chain Bitcoin art. And I think we should explain what those are, because those are what's behind the Three Arrows Capital. It's behind, I think Sam had this kind of oblique tweet that said, some of these exchanges are actually already insolvent. They're already the walking dead. So the first thing to keep in mind is that, this is a completely unregulated market, right? There are no market makers per se that actually have reporting requirements to any regulatory authority. There aren't any clearing houses. There isn't a way for us to understand systemic risk as it builds in the crypto market. So what happened starting in 2018 and 19 is people realized the following things were true. It's sort of what we talked about last week. You go and do some crazy round. You, mark up some phantom equity in a company. That company then issues tokens. You then list the tokens, not on, a blockchain per se, obviously, but in a place where trades can happen off-chain, right? And there's a bunch of exchanges where these things happen off-chain because it's one, company, and then they have a bunch of segregated sub-accounts. And what happens is when these things initially get listed, retail goes crazy, the price goes up, folks basically dump on retail, and you spin that loop as fast as you can, and you can extract an enormous amount of money. Along the way, all these things like DeFi all of a sudden popped out of nowhere, and it's like, hey, you can earn 15, 16, 17, 18%, just deposit the Bitcoin. And so folks would deposit Bitcoin. But then what would happen is like the places where those deposits were held would then need to obviously find places to make that 11, 12, or 13%. And so then they would go off chain to some other random person who was offering to pay them even more than that. And they would try to arb the difference. But it all catches up with you because when something like a Terra goes to zero, all the Bitcoin that was used to basically, run that DeFi process around Terra vanishes. And then all of a sudden you, the lender, are like, hey, can I have my Bitcoin back? And the broker's like, well, actually, I don't have it. I lent it to somebody else. Let me ask that someone else. And they're like, I'm sorry, I don't have it, but I have these Terra coins, because I was running some ARB and now it went to zero. And that's essentially what we're seeing right now. So we have two big problems. And then I think we have a third that's kind of funny. The first big problem is like, obviously in the absence of any regulatory oversight, this stuff is going to happen. Systemic risks are going to build up. That's what we're facing right now, is an enormous amount of systemic risk, largely around Bitcoin. A bunch of this money, I think, has been essentially just vaporized. And so all these people that try to find their deposits, especially in custodial accounts in off-chain brokers, may be SOL at some point. And I think that's just going to be a huge shit show if that actually happens. Anybody have recourse to this Three Arrows Capital and all of this other interrelated parties that are now, gone completely bankrupt because of this scam? The answer is absolutely not. So that's the first problem. You have absolutely zero oversight, which means systemic risk has been built up in the system. The second thing is that exactly what you just said, Jason, is that people don't even understand chain of custody here. Is that you thought that you owned this Bitcoin. It turns out you actually may not actually own them at all. You thought that you were properly lending them out. You actually don't. There is no enforceable contract, it turns out. And so I think that's going to be an entire set of different legal issues that are now going to come to the surface because people who actually legitimately lent this stuff out. For example, like if you short a stock and you go and borrow stock from any one of us, there are really tight guardrails. If you wanted to go and put a credit derivative swap on against debt, there's a central clearinghouse that makes sure you're not over levered. You have to go and get audited by a bank to even get the kind of account that allows you to put these derivatives on. None of that was possible in crypto.
Bitcoin itself, to me, makes sense as a potential. Initially, it was kind of interesting as a potential alternative currency, but the transaction fees were very high. And so it never really seemed to make sense as a replacement for traditional financial networks until those transaction fees dropped below those of the traditional financial networks. And the biggest concern I've always had, which I've mentioned multiple times on this show, is that whenever anyone talks about a quote cryptocurrency, they talk about the price of it in dollars. And if it really is meant to be an alternative to the US dollar, why are you talking about it in the price of US dollars and it's up and it's down relative to dollars? And that implies ultimately that the intention would be transact back to US dollars, which implies that the intent is not to be a replacement for the US dollar, which was a lot of the early prognostication of Bitcoin. Was it was going to be a replacement for the US dollar. It's going to be an alternative to traditional monetary systems. But ultimately, if you're just measuring this in dollars and it's up and it's down, everyone's freaking out every day about crypto's up, crypto's down, that means it really is more like a security. Except securities definitionally are supposed to have a secured interest in some underlying set of assets. And there's no underlying asset. It's not actually a security because it doesn't provide you a secured interest in anything. So it is effectively a bet on some systems of computers that are meant to facilitate some set of activities that, ultimately people really only seem to value in US dollars. So I don't know. I mean, where does it all go? It seems like I mentioned at our predictions episode last year that all of these smaller things are going to get blown out, these quote unquote cryptocurrencies, even though many of them don't really act like a currency. And, maybe Bitcoin itself persists. And it seems to me like that's always going to have good staying power as an observer. I'm not a participant. And, anytime someone telling you something's in dollars and it's going up and it's going down and you're betting on whether it's going to go up or go down and your intention is to transact back to dollars.
I tend to think at this point, Bitcoin probably has to be regulated like a security, even if it is not, and it's more of a commodity because of the volume and the sheer size of both the market and the
potential fallout
markets.
Is the way you're saying it, right? The potential fallout when things go off the rails is so great, you kind of need to have some rails.
Yeah, I mean, like again, as I've said, if you're a market participant trying to trade, very sophisticated, derivatives of any kind, for example, in the credit markets, we have to go and we create these things called ISDAs. They're called ISDAs. And it's basically a kind of an account that allows us to go and, take risk in some of these very esoteric markets. But the underlying principle around that is a common set of parameters, a clearinghouse, the ability to monitor risk. None of those things exist here. And I think that's really what folks have to solve for now. Secondarily is what were all these kind of shadow activities? It seemed too good to be true when you would hear, wow, this DeFi protocol will yield you 24%. And you're just it never made sense really, but then none of us really questioned it